Today, we will talk about capital assets, which are significant pieces of property owned by businesses and individuals for long-term benefit. These assets are integral to a company's ability to generate profit and are represented on the balance sheet. Capital assets can be tangible or intangible, and are recorded and expensed over their useful life through depreciation. Understanding the distinction between capital assets and ordinary assets is important for effective financial management. Capital assets are significant pieces of property such as homes, cars, investment properties, stocks, bonds, and even collectibles or art. For businesses, a capital asset is an asset with a useful life longer than a year that is not intended for sale in the regular course of the business's operation. Capital assets are generally owned for their role in contributing to the business's ability to generate profit. Examples of tangible capital assets include land, buildings, and machinery, which may be liquidated in worst-case scenarios or replaced if a business is growing. While most capital assets are tangible, intangible assets such as stocks, bonds, trademarks, patents, or other non-physical goods, can also be considered capital assets. It's important to continually evaluate intangible assets to ensure they retain their value over time. Businesses may dispose of capital assets by selling, trading, or abandoning them, resulting in a capital gain or loss. Assets may also become damaged or obsolete, leading to impairment and recognition of a loss on the income statement. For individuals, any significant asset owned is considered a capital asset. When selling a capital asset and earning money on the sale, individuals realize a capital gain, which is subject to capital gains tax. Even an individual's primary home is considered a capital asset, allowing for certain tax exclusions on capital gains. The cost for capital assets may include transportation costs, installation costs, and insurance costs related to the purchased asset. The Internal Revenue Service considers the purchase of a capital asset a capital expense, which cannot be claimed in the year of purchase but instead must be capitalized as an asset and written off incrementally over a number of years. Using depreciation, a business expenses a portion of the asset's value over each year of its useful life, aligning the cost of the asset with the revenue generated by the asset. The rate at which a company chooses to depreciate its assets may result in a book value that differs from the current market value of the assets. The distinction between capital assets and ordinary assets lies in the timeframe of their use. Capital assets are usually classified as long-term assets on the balance sheet, while ordinary assets are short-term and used as part of the normal course of business. A fixed asset is a type of capital asset that is tangible with a useful life of more than 1 year, and is usually depreciated over time. Capital assets, however, may also include non-fixed assets such as property held for investment like stocks and bonds for personal gain. A capital asset is defined by its long-lasting value, its uniqueness in relation to not being part of a normal course of business, and its often higher dollar value. It is intended to provide future economic benefit extending beyond 1 year. Gold can be classified as a capital asset if it is held as an investment, but if it is held as an inventory item or raw material, it is more appropriately categorized as an ordinary asset. Capital assets are used for long-term benefit and tend to have rigid, stable, and scalable economic value, while ordinary assets are necessary for day-to-day business operations. Neither is better than the other, as they serve different purposes. Companies can acquire capital assets using initial equity via investments. Investors put money into a business, the business uses that money to buy capital assets, and the capital assets help drive operating income, which is returned to the investor. Capital assets are generally tangible, illiquid, long-term assets that carry higher value compared to ordinary assets. They are recorded as assets on the balance sheet and expensed over the useful life of the asset through a process called depreciation. Both companies and individuals use capital assets as integral investments. Here are 5 key takeaways. 1. Capital assets are used in a company's business operations to generate revenue over the course of more than 1 year. 2. They are recorded as an asset on the balance sheet and expensed over the useful life of the asset through a process called depreciation. 3. Expensing the asset over the course of its useful life helps to match the cost of the asset with the revenue it generated over the same time period. 4. Capital assets may be tangible or intangible, though most capital assets are related to buildings, land, or FFE. 5. Capital assets are different than ordinary assets in that capital assets are more useful in the long term, whereas ordinary assets' primary value is in the day-to-day operations of the company. Hope this would help. Thanks for watching.